Welcome to today's session. Today, as you all know, uh, today is September 6th. It is a Labor Day holiday in the United States. So at this moment in time, the whole U.S. market is basically closed. So that's why today we're not going to be doing too much of trading, but we will be, I will be opening the session to, some Q&A and, but one of the things I want to share with you is the trade that we took this morning. And this trade, if you go to the blog, which I have posted today on FX Street this morning, a few hours ago at 9 o'clock in the morning, as soon as the UK time, we did what we call the portfolio selection. You always have to do the first thing in the morning before you get into the market. You have to do what is known as portfolio selection. And the portfolio selection is what you are going to trade today. This is a key component of your trading strategy. You want to be always looking to buy the currency that is showing strength, and you want to be selling the currency that is showing weakness. Then that would be the primary criteria. And we do this here in Training Traders once every week. We do that every Sunday evening in the weekly trade planning session, and we're going to do it tonight because today is the market is closed, so we're going to do this in preparation for the coming week. So if you look at this morning, if you look at the blog, I'm going to direct you back to the blog again because the trade was initially live, and we were looking at the currency. So this was the radar screen this morning, and while we were looking, we saw that all the pound pairs were selling off tremendously. The pound dollar was coming down about 100 pips. The pound yen was about 100 pips. The pound CAD was down 100 pips. The pound Swiss was down like 70 pips. So the pound was weak across the board. And this is, as you can see here, the pound CAD is just moving down 100 pips. So we wanted to take a trade. We know that the dollar is very thin because the US market is closed. So there is no reason for us, even though I can go short the pound dollar, but still now it's going to be a short-term kind of trade. So we were trying to use a currency across something. We know that there is weakness in the pound. We also looked at the radar screen and we saw that the dollar pairs were basically neutral. I mean, if you look at the dollar CAD this morning, as soon as it comes up, you'll see it on the intraday. This is the London session. There wasn't really much of a move. I mean, the move is from 136, 103.60 to 103.55. So you had about a 15 or a 10, 15 pip move. If you look at the dollar Swiss, you see also a similar situation. And you can see on the daily that there wasn't really much movement in the dollar Swiss. It was just in a very tight range. And as you can see here, this is these are basically from yesterday, from Friday, if you will. I mean, there is no real movement in the dollar Swiss. It's moving in a very tight sideways pattern. The last pair, or last but not least, I mean, if you're looking at the dollar yen, it is also pretty much similar to the dollar Swiss, the dollar CAD. I mean, they're all in moving in 10, 15 pips. So that is not something that would encourage me to start going in and selling the US dollar or trading the dollar. Now, one of the important things I want to share with you is you must not focus on trading one single pair. Some people say I like to trade the cable. Some people say I like to trade the euro. Some people say I like to trade the Swiss or whatever. We all have a favorite. We all have a favorite currency. We all have something that we all like to trade. But we cannot trade the same currency every single day. Because if the market is moving, like for example, if you look at the dollar yen, you could see this big momentum to the upside. So this day was a good day to go long the dollar yen. And right there in those last few days, or from yesterday, Friday, if you would have traded the dollar yen either in Tokyo or in today, there wasn't really much movement, or there was no directional move that will actually reward you. If you decided to go short over here the dollar yen, it moved up against you. If you decided to buy it over here, it moved down. If you decided to short it again, it came back up. So in this sideways move, you would end up giving back all the profits that you have made on this kind of a trade. If you would have taken that trade, I think you traded the NFP with Wayne on Friday, and that was a good trade. And if you made that money on Friday, if you come and try to trade it, you go short over here, it goes against you. It is now in this sideways pattern. You would have given back all the profits that you would have made on this kind of a big move. So therefore, you must have a selection. You're not focusing on one trade, because if now this pair is not moving today, then fine. I'll let this pair rest, because after this big move, that instrument has to rest. It has to pause. It has to get in what we call a price acceptance zone, where people realize now that this is either the new fair market price, or that the market is going to change. Yes, Bill, I'll come to it in a second. So with that, you must have several currencies. And with those several currencies today, if the euro dollar is not moving, then you can go to the euro yen. If the euro yen is not moving, you can go to the pound Swiss. And you can always stay with the majors, so that you are not paying, number one, too big a spread, and you are in a heavy currency that you have some sustained move in that specific direction. The way we, as I said to you guys, today mostly is going to be a Q&A, okay? So, I will answer Bill's question, and I will try to answer most of your questions, because as I said, the market is closed, so we are going to be doing mostly Q&A. So, Bill's question, what do I look for on the daily to determine what pairs do we trade? Well, what we do, the way we do this, Bill, is we have this is what we call our, let me do a little bit of a formatting here so you can see what I'm looking at. Now it didn't work. Alright, I wanted to show you what we do we look, we have the radar screen. This is what we call the radar screen. And as you can see, we group the pairs. So for example, here I'm grouping all the pound pairs. I'm grouping all the Aussie pairs. I'm grouping all the Euro pairs. And I'm grouping my yen pairs. So with that, I have those currencies in groups. And then we have what we call our deltas or our retracements, and these are gauges that we measure the extent of the move. You can use the net change. I mean, the net change can suffice for you. So for example, if you look at these are from the last session, you can see that the dollar Swiss has moved 14 pips. The dollar yen has moved 10 pips. But the pound CAD has moved 146 pips. The pound yen has moved 114 yen. That's the pound Swiss. It's beginning to change. The pound dollar has moved 90. So you can see from the net change that the pound has been weak and it's moving extensively. Now you come back down, let's say, to the euro. These are the euro pairs. And you can see that the euro Aussie is 27 pips. The euro CAD is about 60. The euro Swiss 36. And the euro yen is 20. So you can see that the average move in the yen is about, in the euro, is about 20 pips. So the average move for today, Bill, is about 20 pips on the euro. And the average move in the pound is about 100. This means that the pound is 5 times weaker than the euro. Do you see what I'm saying? The pound, I mean, this is simple common sense. This is simple common sense. The pound is 5 times weaker than the euro. So with that, Bill, which one do you want to go short? The pound or the euro? Definitely have something that is 5 times weaker, then I will be going short the pound. And if I'm going to go long the other currency, then I can go something which is like the euro, which is at 1/5 the weakness. So in that case, and this is the trade that I did this morning when we were planning when I did the trade before when I put the blog, we said, okay, the pound was extremely weak and the euro was also weak. I mean, was also negative, but the pound was 5 times weaker than the euro. And that was sufficient enough as a tool for us to take that trade. And this trade was taken from here. I'll show you the trade. And this is the stuff that I do for you in the blog every day. So I try to put that for you before the market is open. And having done that, it became that the euro pound was one that I will be looking to be a buyer. I will be looking to buy the euro and I will be looking to short the pound. It's just downloading some of the data here before the signal comes in, and you'll see that the trade that we took this morning. And if you go to as I said again, to the blog, you would see the trade at its inception before we were actually doing the choice. I walked you through, now I'm going to do this, waiting for the data. So the trade was from here. Anyway, I'll show it. So, so this way is one of the tools that you can use in identifying which pairs are stronger than the other pairs, and you can use that to execute the choice. The other pairs, again, you want to be looking at if I'm going to do the same process again, we can see that the Canadian is very strong across the board. The Canadian dollar, the dollar CAD was moving 39 pips. The pound CAD was moving 150 pips. The Euro CAD was 72 pips. And so in this case, the CAD is extremely strong. So if I wanted to buy the CAD and I don't want to be caught in the volatility of the fluctuations of the market moves, then I would be looking to buy the CAD in addition to the techniques that we train you here on how to enter and buy the, but in principle, you will be looking at the weakest against the Canadian. So if I'm going to go long the CAD, then my first candidate will be to short. Which is the weakest in this? Is the Euro weaker than the pound? I mean, when we did our selection, we chose the pound as weaker, 5 times weaker than the Euro. So in this case, I can go first short the pound CAD. Then I can my second choice would be selling the Euro CAD because it's giving me 73. The least would be the Aussie CAD. And again, the only thing, just based on this, you're looking at strength. You want to buy the strongest of the strong and you want to sell the weakest of the weak. Okay? All right. Jack, what is your question? What do I see the pound doing? Personally, I believe that let's do the pound together. I personally believe that the pound is in trouble. It is making a lot of, or giving a lot of sell signals. These are what you see here. This was our initial sell signal in the pound, which is the 159.80. That was our first sell signal over here. And these are all we identify, as I said, in the Sunday session, in the trade planning session, you would see all those price points. We put them in the radar screen as a structure point, a turning point. So we do all that work every week, and we trade them all the following week. So you can see here that the pound, that was the first sell signal, and we technically were basically short from the 159.80, and it just came back to the 155.33. It just, look at this. And this is when you're looking at these structure points and you learn how to identify them, you will be able to gauge the strength or weakness. Because the first structure point was the 159.80 right there. And then the second structure point is right here, the 155.30. And that's the beauty of price behavior, because it doesn't let you wonder too much. There is no subjectivity in it. We all see the same thing, and we all come to the same common sense kind of a judgment. So let's go through the judging process. So this here is one level of a structural point. This is the second level of a structural point. And we sold off from the 159.80 all the way down to the 155.33. And we broke it. When we broke it, we did break it with strength. And then the price, as you see here, came above the structural point. And you all heard me say before, if the prices go above a reference point or above a structural point, that would be a buy signal. Now, Jack, right there, it went above it, and if we expect now to go long above the 155.30, and it is a structure point, then we expect a big move to the upside. That's the typical normal behavior at or about the structure points. The next day, this is what happened. There was no continuation to the upside. There was no continuation above the structure point. You heard me discuss with you what's known as the failure trade. So now the prices was going up. It traded above the structure point of the 155.53. Then it failed to stay above the 155.33, and then it came back and it closed below the 155.33. So you tell me, Jack, where do you think the pound is going? Up or down? Simple common sense. We're not predicting. We don't do prediction. I don't predict. Neither should you. Okay? Prediction is for somebody that has a crystal ball. Okay? But we don't have a crystal ball. So, and we all know that we are as mortals or human beings, we rarely see the future. So, since I know that this is something that I do not possess, then I'm not even going to attempt it. So, right here, it's below the 155.33 Jack, and you see that it has failed to go that. So, in that case, you want to be short, and this is where you are today. And we're still now going, or should be going, towards the next level, which is the 152.48. And we're sitting right now at this level. So I have no reason at this point to be anything other than negative or short the pound. Plus, in addition to what you are seeing here today, Jack, you can see that the extent of the move that has happened today in the pound. Look at these. These are the trades that we took this morning in the pound. These are the two trades in the morning in the pound dollar. This was one trade. This was the second. We closed it right there. So we went short the pound today at 154.64, and theoretically you can say we closed it at 153.57. So that's about 100 pips on the pound trade today, the pound dollar. And we just follow the basic rules. So with that, if I'm looking at the extent of the move today in the pound, giving me 100 pip move in the pound dollar, and giving me 150 pip move in the pound Swiss, and giving me these kinds of big moves, that tells you that there is an inherent weakness in that currency, and there is a great deal of selling that's coming into it. A lot of people are getting out of this currency. If that's the case, that kind of selling that you see, this big selling that comes in, can only be interpreted that should lead to further continuation into that direction. You cannot see those big buys or sells that come into the market and then you expect it to reverse unless there is some sort of an intervention. These are the trades that in the pound Swiss, we took one trade this morning in the pound Swiss and we went short at 156.905. And this is, if it's a blue line like this, then it's a winning trade. And we closed the trade at 155.70. So it's also about another 110 pips or 120 pips. So, and that's why we took, as I said to you this morning, as I said in the blog, we're taking all the, look at the pound CAD, we're taking short all the pound, pairs. This was the other trade that we took in the pound CAD, and then you can see it. But anyway, this is how we do that. And as I said, Jack, we're looking still for a further continuation for the pound to the downside. Okay. Anybody has another question that we would like to ask? As I said, today we will be doing mostly Q&A because of the holiday. This is the trade that we took in the pound CAD. We went short at 160.47 and we covered it at 159.20. So we had 140 pips on this trade, and then we went short again at 159.15, but the market did not go down, it went up. So we closed it at a loss of about 10 pips plus the commission. So we took 150 pips and we took the second trade in the same direction, but it moved up. And this one we took a loss on it of 15 pips. Okay, what else? Who has any other question? Come on, Leon, you're quiet. Are you kidding me? You have your chance now to ask a question and you're not asking? Oh, I'm sorry. I'm seeing them now. Hold on. Oh, okay. I stand corrected. Okay. Roman. Okay. What do I think? Hold on. What is that? The point is, Jack, when you say down, you're correct when you say down, but not too far down. When you say not too far down, this means you have taken the right direction. Then you have done a little bit of a prediction again. Okay? You have predicted that it's not going to go too much down. Once you make this kind of prediction, Jack, what you're going to do is you have now are going to convince yourself that it is not going to go too far down. Therefore, you're going to close the trade too soon, and suddenly you'll be satisfied with 10, 15, or 20 pips profit, only to get out of the trade, and you would see that the prices continue in the same direction that you have anticipated, and you're sitting hurting about all the money that you should have and could have made if you stayed with the trade. And all of us have been through this situation, not just Jack. We take profits too soon and we sit and regret, or we even predict or anticipate that the market is going to go up, but we don't take the trade. We don't pull the trigger, and then we sit and fret and agonize on all the money that we could have made. And the primary reason for that is the way we approach the market is a wrong way. It's a wrong way. predicting is wrong. If somebody says to me, and again, I'm not talking about anybody, guys, I'm talking, if somebody says to me, I think the Dow Jones or the S&P is going to go to 1162.5, and that is going to be resistance, and it's going to come back down, I would say thank you very much, and I would walk away. He's playing God. He has a crystal ball. He might be lucky once. He might be lucky twice. But you cannot put your kids through college by being lucky. You have to be consistent. You have to do things in the proper way, day in and day out. And if once in a while you get lucky, then all the power to you. We all need a little bit of luck once in a while. But you cannot trade based on luck. You cannot trade based on a guess game. Also, you have to think the way you approach the market, the way you think is very important. And the biggest thing, the biggest challenge that we have here in training traders is changing people's mindset on how to think. I will come how to think about when they're trading. The idea that, for example, let me go back to Jack, and I'm not picking on you, Jack. I'm just sharing because we had the little dialogue between us. But for example, when you say it's not going to go too far down, or somebody says, I think it is going to go down, and I'm going to go short. I am only going to go short if, no, I swear I'm not picking on Jack. If it breaks below a price point like the 159.80, then my choices is to go short. I want you to think of something, guys. This is what trading is all about, okay? And I keep on doing this all over take a look here. Let's say at 162, forget the name. The last thing you care about is the name. When we teach you here to trade, you don't care if it's the pound, what's happening with the BOJ. You don't care about that stuff. It's not important. Why? Because the amount of cash that we have in our pockets is very small. And we cannot influence the market with the amount of money that we have in our trading account. But a guy in Goldman Sachs can influence the market with the amount of capital or the amount of position he can be putting into the market. So I don't need to tell the guy, assuming that you and I are correct, okay? Me and Jack and Leon, we all sat down and we made our analysis exactly that this thing should be a buy at 162 and it should go up. We all did our homework. We all were correct. We all are right. We covered every piece of information, and we are sure that the pound CAD should be going up. The other guy who is at Goldman Sachs, who has more money than God, and he's trading hundreds of millions of dollars, made a mistake. Instead of whatever, he made the wrong calculation. By virtue of the number of contracts that he's going to come into the market and sell and bring all that kind of liquidity, or call it supply, if you will, because some of you like the term supply and demand, by bringing all that supply or selling into the market, even though we are correct in going long, but this person is going to push the market out and he's going to get us out. All right? So that's why we want to look at the price and we identify what we call a reference point. So let's say this is my reference point. So at this reference point, let's say I'll make it 162. So let's say my reference point is 162. All right. So now I want a volunteer, one guy, one person, and I want them, all of you. I want you all to answer. Okay. At 162, we don't know what's happening. At 162, who wants to buy? Again, it's a guess game. We're playing a game. There is no right answer. There is no wrong answer. It's a game. We're playing a game. Who wants to go long at 162? Okay. Who wants to go short? I want to see how many long, how many short. Okay. Okay. See, Donnie, what you're trying to do is you're trying to hedge yourself. You say buy if it is 50% fib. No. Sell if below 50%. You're trying, I want you to pull the trigger irrespective of fib or mib or whatever. It doesn't make any difference. All right. Now here is the point, guys. Here is the point. Basically, at this point here, we have three choices. Three choices. We can buy, we can sell, or we can do nothing. Some of you wanted to buy, some of you want to sell. So let's say it's equal. You will only be right. You will only make money if you are correct. And since we have three choices, the market can either go up or down. Or if you're doing nothing, you're staying on the sideline. So this means that the odds of you making money, the probability of you making money is 1 out of 3. You can only be right 1 out of 3. You can make one correct decision out of 3 decisions. So 1 out of 3. And that means that your odds of success is 33% that you are going to make money. And the odds of you not making money is 2 or 66%. You're not going to be making money. Exactly. What would I do? Then what I would do is, like, this is my reference point. That's what you see here, Bill. And I don't think, because if I predict and if I think, then I am putting my ego on the line. I would have made a mistake. If I buy and the market goes down, I would have said, Mike, you made a mistake, and I'm still convinced that I'm right and the market should go up. So I will decide, okay, I am not going to go short. Or the vice versa. If I go short and the market goes up, then I say, okay, I'm not going, because now I was wrong. I was wrong. When you predict the market, even if it's a 50% Fibonacci, Donnie, or even if it's, whenever you put that prediction in, whether a price target or whatever, whenever you put that prediction in, you put the term I. You put yourself in the mix. You put yourself into something you have no control over. And suddenly, if the market, like I told you, the example of the guy from Goldman Sachs, I mean, he's a fictional guy. If he makes a mistake and he sells 1,000 contracts and he pushes the market down, so he stops us out. So even though he is wrong and we are right, we ended up losing on the trade. If I put myself as I will not be able to turn around and then go short with the guy from Goldman Sachs so that I can recoup my losses. Because if I wasn't wrong or I wasn't right, and if I'm always following a set of rules, then what happened is that the market condition has changed, and now I have to apply a different set of rules. But it doesn't mean that I made a mistake or I was wrong. All what it means is that now I need to change, and instead of going long, I will go short. And you can do that with ease, with simplicity, and without even fretting that you have had an ungainful or unwilling winning trade, because it is not, you did nothing wrong. You followed your rules, you applied your entry, and just the market went into the other direction. And this way you'll be able to jump in and to capture the next trade. Okay? Alright. What other question? Schedule, what do I think about the pound yen? Is it highly likely that it may break the 128 support last week? Let's see the pound yen. Yeah, I think so. I mean, to be honest with you, as I said, the pound is in trouble, but the yen is also in trouble. I mean, the problem with the yen is it's getting too strong, and it's an interesting story, the yen. The Bank of Japan now wants the Japanese people to start getting back or unwinding their hedges. I mean, most of the Japanese companies, the big companies and stuff like that, they have hedges they are short the dollar, and they're selling the dollar, buying the yen. They're hedged a lot. And most of these hedges, they are doing it on margin. So like, for example, when you trade foreign exchange, you have a margin of 100 to 1. So you put $1,000 and you control 100. These guys also are using the same marginalized accounts or similar marginalized accounts. So the Bank of Japan has now, or the Ministry of Finance has asked these guys that before the end of this fiscal year, by December, they should unwind these margin hedges, and they can only keep the positions that is fully paid for. So all their hedges should be unmargined, and that of course should be bringing some selling, if you will, into the yen, but not right now. Having said that, the question is the yen should be going, the pound yen should be going down any further. Based on the chart, yes, that it should be going down, and probably it will take down the 128.60, if not further. It's already there. I mean, it's just a matter of time. Okay, what else? SL, what's this? What was the SL for the pound dollar short earlier? What does SL? What does SL mean, Haribo? stop loss. Okay. The stop loss is always one of the ways we do that. These are basically our stop losses here. The stop loss changes technically. So today in the first session, this is what we identify the stop losses for each pair, because you cannot use the same stop loss every day. The idea of I'm going to use 20 pips stop loss or I'm going to use 30 pips stop loss, it doesn't work this way. Every session. This thing is working all day long. Every session, yeah. That's why we call this the radar screen. It's an extremely powerful tool. We don't trade without it. It scans the market for us. No, it's not. Nothing that we use here, Haribo, has anything to do with any technical indicator that you have out there. We don't use moving averages. We don't use none of that stuff. And there is a simple reason. That stuff does not work. It's over. That stuff doesn't work. And that's my opinion. And you don't have to be, some guy even in FX3 said to me, put a comment that said that I should have an open mind. No, I don't need to have an open mind. I know that stuff, this is how I trade. That's my opinion. If he feels that this stuff works, then all the power to you. Then you're a better man than I am, and God bless you. Go and use it, and all the power to you. Why does all this technical stuff and all this? We are technicians. We use technical trading. We follow the essence of the technical analysis theory. We apply it to its essence, to its bone. There is a meaning to every word that is a part of the technical analysis theory. But the tools that are now available are the same tools, guys, that other traders are using to take advantage of the small trader. If you're going to bring a programmer today, somebody like, for example, Haribo, who was asking, is it derived from ADR? The first thing somebody does any programming would do, okay, this guy is using a 25 period moving average. Now I'm going to use a 24 period moving average, or I'm going to use 20. Everybody's competing on how to use the moving average, or who has the shorter moving average. So if you and I are using the moving average, then the one with the shorter moving average or the faster moving average can take advantage of the one with the longer moving average. And there will always be somebody that is using a shorter moving average than you. Even if you use a moving average of 2 period, which is as short as a retail customer can use, the guy in Deutsche Bank or the guy in Goldman Sachs or the guy in any institution bank, he can use a shorter moving average because he's not paying any commission. You are limited with a 2 period moving average because you have to pay a spread. These guys, all the money they make is that spread. So they can trade as short as they want or as long as they want. Plus, you have heard the statistics out there that the majority of the people that are coming into the market today struggle or they're not successful for, a large majority of them. And these are statistics, they're not my statistics. So the question is, what are these guys are using? The guys that are not successful, the guys that are not making money, what are they using? They're using those technical indicators, the divergence, the stochastic, the moving average, the MACD, blah, 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 and all that kind of stuff. So if they are using it and they're continuously losing money, and if we continue to do that, and we can expect a different result, that's what's called the definition of what, that. If you do the same thing over and over and over again, and you expect a different result, unfortunately, that's not the right way, Einstein said it, that's the definition of insanity. So if I'm going to continue using this stuff and I'm not going to make money, why should I use it? I have to find something that gives me the advantage. And that's why we use the price behavior. Exactly. All right. So I've got a couple of more questions. Jack, I understood that today's sell-off in the pound is relating to a temporary sell as a result of something occurring tomorrow. Given that the dollar is in more trouble than the pound, do you not see a rebound soon and the bulls are pushing the pound up? Okay, that's a brilliant question. But so let's do it this way, Jack. Let's put the pound dollar and let's do it. I'll show you how we do that based on price behavior. This is the pound dollar. So what the argument that Jack is bringing forth, and it could be a very valid argument, the dollar is in trouble and the pound is in trouble. And there is an argument set forth that we might get a rebound in the pound. Well, the way we do that, Jack, we bring in a reference point. The reference point would be, hypothetically, again, this is not the reference point here. I'm going to, all the structured points I'm going to do this afternoon in the trade planning session today at 7 o'clock London time. So, but hypothetically, let's say I'm going to use this, the 153.90. Let's say the 154. Okay? So, Jack, you might be correct, and this is how trading is. It is not that Jack is right and I am wrong, or I am right and Jack is wrong. No. You and I, Jack, are students of this market. We are in this market to make money. So let us agree. If the argument, not Jack, if the argument that the pound now and the dollar is weak, then the pound should get a bounce and the bulls will come in. If this argument is correct, then we should see the pound get above the 154 level. If the pound gets above the 154 level, then Jack and I will say that this argument is now correct. It has nothing to do with Jack. It has nothing to do with me. I'm not arguing with Jack. I'm not debating with Jack. He has a valid point. I respect it. But I'm able to identify if this argument is correct, then the pound should be trading above the 154. And if it goes above the 154, then this argument is correct, and I will be the first one to join in with Jack, and both of us will be buying the pound. If the pound is not above the 154, then this argument is not correct, and Jack and I will be shorting the pound. And this is how simple price behavior is. Okay? And we're not putting again, we analyze and we put our reference point, and that is our decision making point. Thank you. Okay, what else? Whenever we see momentum on any pair, I wonder how to take momentum trade on it. This is it's a big question, Leon. I will. You want to be trading in the direction of the momentum. The question is, there are rules on how to get into the momentum trade and how to. It depends on the time frame you're trading. If you're looking at a 5-minute bar, if you're looking at a 15, if you're looking at a daily, there is more to it than just. But what you want to know, the best answer I can give you is, you want to be trading in the direction of the momentum, and we will be doing the pound today, Jack. You will be doing it this afternoon. Okay, so to tell you this, Leon, number one, don't trade the 5-minute bar. Okay, that's the short answer. Okay, because the 5-minute is not for a guy like you and me. Oh yeah, absolutely. The 5-minute, these are for the banks, the guys that are in and out every second. The 5 minutes, the 1 minute, the 3 minute, these are for the high speed momentum guys, and these are mostly computers and big size guys, and we are small traders, all of us. As long as you're a retail customer, by definition, just being retail is, you cannot, even if you want to be a day trader, we're day trading all day. I mean, this is the trades that I did. I showed you the trades that we did today. We took on the pound pairs. Here, look at this is the pound dollar. This is the pound dollar we took today. Here, these are the trades right in front of you. These dashed lines, these are the trades. These are the trades. This is, we went short, as I said, from 154.60, and we covered it basically at the end here at 153.57. That's 103 pips. I can give you the losing trade example, but again, the losing trade, I think in the pound Swiss today, or the pound CAD, I guess. The one thing I will show you, the one thing, Haribo, is trading has 5 components. Trading has 5 components. This is, no, this was okay. I think the pound CAD was. There are 5 components in trading, guys. 5 things. The first thing is portfolio selection. What should I buy? Or what should I sell? Portfolio selection, that is the most important thing that you should do. And that's why we have this radar screen. This is what it does for us, is our portfolio selection. And we do that portfolio selection in our trading room with all our traders before every trading session. If the market is opening at 8 o'clock, we are in the room with all the traders at maximum 7:45. And we're all doing the planning. So we're choosing, we're going to do the pound yen, we're going to take the yen pairs, we're going to take the dollar pairs, whichever. That is our portfolio selection. These are the currencies that we are going to trade. And the reason we do that, and that's why it minimizes our losses, because we're only going to trade the ones that give us the best odds of success. The second thing And this is the losing trade that we had today. Again, today is an exception. I mean, don't think I'm telling you that this happens every single day. No. But, I mean, there are some days that, it's just things are not working. So, but today was a good day. And we had 150 pips on this trade winning. And on the losing trade, we shorted at 15 and we covered it at 23. We lost 7 pips on that trade. So today was a good trading day, but not every day is as good as this. But on the days that it is not doing that well, our losses, as you see, is 15, 20 pips, 25 pips. But when it goes, I'm taking the 100 and the 150 pips in my way, and that, so the second thing that you need, the first thing is the portfolio selection. The second thing that you need is the optimum entry to get into the trade at the best possible time, at the beginning of the move. You do not want, like Leon is asking, I see now momentum, I want to get in, but I'm scared it might be a reversal. Well, if Leon gets into the trade early and he catches this momentum at its beginning, then he would not have any reason to think of the market is going to reverse or not, because he already has a profit cushion. That's the second thing. The third thing you need is to get out of the trade at the best possible time. And when I say the best possible time, I mean the best possible in a statistical sense. So you want the portfolio selection, the optimum entry, and the optimum exit. Plus, you want to have, I'm going to answer all the questions, guys. And you want to have what is known as number 4, auto execution. Because you want to be able to delegate to your computer to execute for you whatever trade that meets your specified or specific criteria that you identified at the moment you did your portfolio selection. So you would say, I'm going to buy the euro pound, I'm going to buy the euro yen, I'm going to trade the euro pound, the euro yen, or the euro pairs. And as soon as I get the buy signal, I immediately want to be in. I don't want you to come back to me and let me look at the chart. Get me in. That is what's known as the auto execution. Okay? And these, of course, and then you need the support or sitting with a group of traders that see things in the same light or follow the same set of rules so that you do not veer upon it. Okay? All right. Thanks, Romans. What does Romans say? Yes, you have to let the profit run. I mean, the exit is statistical. I mean, the exits when we say statistical exit, there are no 2 days that are similar in the market. There are no 2 days that are identical. But there are certain setups, certain behavioral patterns that we are able to quantify, and they are repetitive. And if there is a certain pattern, I can say that that pattern usually gives me about, let's say, 60 pips, or when it turns, it has to behave in that specific way. So until I get a sell signal, I am staying with it and I'm going to trail it with stops. Okay? No, the exits again. The software, the way we have it, we have we do auto execution. Most of my work is done by auto execution. So we have we pick up the charts, 4 or 5 charts. Give a quick example of what. I'll tell you about gold. Okay. This is the. Well, I've opened the gold. We have 2 trading techniques or 2 trading. This is basically what we train the traders here, either long-term traders or short-term traders. And again, basically everything we do revolves around the portfolio selection, timely entry, and timely entry. So if you look at the gold, somebody wants the gold, you can see that these are our long-term positions. We're long the yen, we're long so let's see the gold. Where is the gold? If I have nothing here, this means it's empty. We have no position. Okay, here is the gold, GC. It's trading at 151 now. And we were long from August 13. Who's asking? Roman. We bought it at August 13. This one, the signal came in. And we bought it at 12.19. And we're still long. And everything that we have or not, you can see this is our position. This is the date. So corn, for example, we're long corn from $4.14 from August the 2nd. Everything. So let me go to gold and you can see. This is the position trading. This is the long-term trading for people that are cannot sit in front of the screen all day long. And this is the strategy. This is the trade. And we're from here. This is we're long, as you see, from 12.19. And these are all, as you can see, these are all winning trades. This is some losing trades over here. But the majority these are all this move. We've taken it from the 8. Anyway, the all-time high for gold is the 1269 or something like that. 1266. We're sitting pretty much near the high, so you got nothing to fear about it. I mean, I would stay with it, especially if the argument about the gold and the silver and the about the pound and the dollar. And you guys, if the ones in the UK and the ones in Europe, if you can buy gold in British pound or euro in British pound, it is, or gold in euros, it's much more, it's at all-time high. This is the dollar-based gold, but there is gold based on the British pound. There is gold based on the euro. And if you buy gold with one of those currencies, you'll actually see that you're at an all-time high, historical all-time high. All right, what else? Anybody has any other question, guys? No, we're not long the pound. The pound, we're flat. I'll show you the chart for the pound. You see, we took we were long the pound from here, from 152.40, and we closed the trade at 155.50. So we took 250 pips on the portfolio, on the long-term position. Yes, you can have the software, you can have anything you want. Anyway, let's, who was asking about something? You can, Leon, I mean, this is an education. So if you need anything, contact James or anybody here. So what else you guys, well, James will be more than happy to answer all your questions about subscriptions and stuff like that. Who is asking about the pound dollar? Why did I take the 12.155 as a structural point? No, I didn't. This is not a structural point. Who's asking that question? It's not. The structural points are the one you see in light blue. You see the sienna blue? Yes, guys, all of you, we have a free weekly newsletter. Completely free, no strings attached, nothing. That covers the S&P, that covers some of the golds, that covers some of the stuff. You can go to Training Traders and subscribe to it, and you'll get it for free. So we cover some of that stuff in it. And this is it is a little bit part of the, it's not everything we cover, but some of the things that we cover. So the 1248, the 152.48 is not a structural point. The structural points that we have is identified by the sienna colors. And this is how we identify the structural points. So the 152.48 is just a reference, like a short-term support or whatever. But the next structure point is all the way down at the 148. Okay? What else? We've got another 15 minutes or 10 minutes to go. Can I talk about what we do, Jack, is we trail it down. Yes, it should be coming down. I mean, we trail it down with structural points or reference points. Once the market breaks, we do not trail it with stops in the form of how many pips. We trail it with specific entry points and exit points that will tell us to get out of the trade. And usually when you take a long-term trade like this in the pound dollar, usually the long-term software is the one that gets us south. So right now, this is the pound dollar. We're flat right now. We took it long. Now we're basically flat, but we're bearish and we want to be short. And if it takes the short, then we will stay with it because it will give us a statistical exit to get out. But yeah, absolutely, it should go down to the 151. Again, let's say you have the 151.20 as a reference point, Jack. Okay? Well, once it gets down to 151.20, you begin to anticipate, or you begin to see how the pound is going to react at that specific price point. You don't want to say it is going to go to 151.20, and as soon as it gets there, you want to take your profits and run. I would rather, if it goes down to 151.20 and it bounces 50 pips and I'm staying in it and I give back 50 pips, because I know it will be rolling down and it's going to come back and give me another 200 pips. So if I predict, then I'm going to cut myself short from the profit. The structure points, this is part of the how the chart is built, and this is based upon the rules of technical analysis, and there are several points that we have structure significant and and this is how the chart is built. And they are psychological price points at the chart where the markets have made specific decisions, and we try to identify them on it. It's not a topic that I can cover in the next 7 minutes, but if, for example, if you want these numbers, we usually, as I said, we do them every Sunday at 7 o'clock, and what we do is we build the radar screen, and you can take a screenshot with every structure point, long point, short point, everything, and you can use it whether you have MetaTrader 4, whatever. You can write them down on a spreadsheet and use them. But it is part of the process of how the chart is built. So initially, the short answer for you to get these points is try to get into the Sunday session. You'll be able to see those numbers and have them. And maybe in the process, you can learn how they are derived, because of course I explain every time how I took this number, how this number has become. Okay? What else? Kung Fu or Kangu, are there daily pip limits for pairs to avoid getting into a trade at the end of the limit? I don't understand that question. Well, no, it's simple. I mean, if it gets above a reference point then you're looking to buy. You see, if it gets above the reference point, let's say you have a reference point. Let's say this is my reference point, the 155.30. If it gets above the 155.30, then I have two choices. Not three. Either to buy above 155.30. That's one choice. The second choice is to do nothing. Short is not an option. If the prices are below 155.33, I have two choices. Not three, two. I can sell below 155.33, or I can do nothing. Buying is no longer an option. This, guys, is the essence of trading. That is, when you are able to do that, and you can do that empirically, and you can do that purely, that is the moment when you can say to yourself, I am now a trader. Now I am thinking as a trader. And let me explain that. As a trader, remember when I said you have three options. So the odds of succeeding, or the odds of you making money, is 33%. And the odds of you not making money is 66% of the time. So forget losing money. I say not making money. So if every 10 decisions you're going to make in trading, you're going to make money on 3 of them, and you're not going to make money on 7 of those decisions, and you're probably going to lose on some of them, that's not a way to become. It's simple, because you have 3 choices. That's it. I mean, look at any chart. Let me hear. Hold on. I'll tell you how I come with this percentage. Look at this chart here. Hold on a second, quick. Okay, I'm going to show you this exercise. I'm going to move it here, right there. I just move it somewhere nobody knows. Okay, it's right here at 198. Do you want to buy or sell? There is no wrong answer, Plumber. There's no wrong answer. You want to buy or sell? Whatever your gut tells. Or do nothing. What do you want to do here? And that's the challenge every single day, every single trader faces. You're looking at the right-hand side of the screen. Fine. If it's nothing, you need more information, then you're doing nothing. But if you have information, what will you do? You can buy if the information is good, or you can sell if the information, exactly. So you have what? 3. Then you have 3 information. You have only 3 options. You can buy, sell, or you do nothing, right? These are the 3 options you have. In that case, yeah, Jack, I'll come back to this. In this case, for you, the odds of making money is 1 out of 3. This means a third, let's say it's going to be equal. A third you're going to make money, a third you're not going to make money, and a third you're going to lose money. Okay? Who wants to get involved with a business like this? What kind of business is it that you want to get involved with if only you're going to make money a third of the time and not make money or lose the 2/3 of the time? If that's the case of trading, I don't want to touch it with a 10-foot pole. But what I want to get involved with is a business where it's upside down, where I make money 66% of the time and I lose or not make money 33% of the time. I want to reverse the options upside down. So if I put a line like this, Jack, let's say I'm putting a line like here, like this, right? Let's say here, 197, and let me put it right there, just hypothetically for example. If it gets below 197, make it 198 so you can see. If it gets below 198, I'm going to sell. If it goes above 198, I'm going to buy. So above 198, I only have 2 options. I can buy or do nothing. If it gets below 198, I can sell or do nothing. So now, if let's say Kevin, the price is now above 198. You have how many options? How many choices do you have? All of you. One is right or 2. You have 2 exactly. You can either buy or do nothing. Exactly. Now, what are the odds in this case? Exactly, guys. So in this case, what are the odds of you making money and the odds of you not making money? It's 1 out of 2. Exactly. It's 1 out of 2. Just by this little trick or technique, I raised your odds of success from 33% to 50%. 16 percentage points. That's what trading is all about. Price behavior, understanding, putting the odds on your side. Now you're 16 percentage points. You have an even chance. Well, that's now with the additional techniques, we get into the entry, the structural points, the significant points, all that kind of stuff. That gets you not to the 66%, now it gets you to the 70 and the 75%. But just by identifying the structures, the significant points on these, you have now put yourself in a situation where the market now gives you an even deal, a fair shake. And that's what trading is all about. Taking care of the odds, using the probability, and knowing which way to trade. Above 198, you know you want to be buy. Kevin said, I only want to buy. You know you want to buy. That's it. You know which direction you're going to trade. 2, you're using the odds, the probabilities. Now, 3, you're not predicting. You're reacting. That is what trading is all about. Okay, I think now, Adinda, I think we're coming to the time now, or anyway, guys, Adinda, I think we're up. I don't know who's the next lectures. I think it's 1:30. So anyway, while she's coming to me and tell me when, if anybody has one last question. Absolutely, it can easily get down to the 149.80, but it's going to take some time, Jack. But it's going to go down there. Yeah. There is a lot of articles on the website. There is a lot of free seminars, webinars. I mean, we have on the website. Feel free to read them. And I do the blog again every day. If you subscribe to it, I do it like 3 times a day, one before each session. I try that as best as I can, so you can get some of the just it's on FX Street. It's on FX Street. FX Street. Go down to the blog. It says Mike Baghdady and subscribe to it. It's on FX Street. You're not going anywhere else. Exactly where you are now, right? Just go to FX Street, Jack. Thank you.